Welcome to ARGUNAS Learn. Today, we're tackling a really fundamental concept in finance, asset classes. Whether you're just starting to build your first invest-in portfolio or you're preparing for your NISM VA certification, nailing this down is absolutely your first step to success. You know, when you're new to investing or even just studying for the exam, it can all seem a bit overwhelming, right? You hear about stocks, bonds, mutual funds, gold. It feels like this huge, complicated puzzle. The big question is, where do you even begin? Well, the answer is actually simpler than you might think. Before you even think about picking a specific stock or a mutual fund, you need to step back and understand the big picture. And that big picture, that foundation, is built on asset classes. Really getting this concept down is your key to clarity, both for your investments and for the exam. All right, here's what we've got on the cards for this explainer. We'll start with what asset classes actually are. Then we'll introduce the 4 major categories. After that, we'll look at how this all works in real life and what it means from an exam perspective. And finally, we'll wrap it all up with the key takeaways. So first things first, what exactly are these asset classes everyone talks about? Well, the easiest way to think about them is as the fundamental building blocks you use to construct your entire investment portfolio. So what's the official definition? It's actually pretty straightforward. An asset class is just a big group of investments that have similar characteristics. They tend to react in similar ways to economic news, they're governed by similar rules, and they generally kind of move together in the market. But, you know, definitions can be a bit dry, so here's a much better way to think about it, especially for us here in India. Imagine your entire investment portfolio is a cricket team. Now, you wouldn't want a team made up of only fast bowlers, would you? Of course not. You need solid batsmen, clever spinners, a reliable wicketkeeper. Each player has a different job. Asset classes are exactly like that. They are the different players on your team, each with a very specific role to help you win your financial game. All right, so let's meet the key players on this investment team of yours. There are 4 major asset classes that you absolutely have to know inside and out: equity, fixed income, real estate, and commodities. First up, we have equity, which you probably know as stocks or shares. In our cricket analogy, this is your star T20 batsman. This is your big hitter, the one who comes in to smash sixes and can potentially win you the match in a flash. The main goal here is aggressive growth, what we call capital appreciation, making your money grow by the share price going up. It's super exciting, but it definitely comes with a high level of risk. So let's break down this star player's stats. When you buy equity, you're not just buying a piece of paper, you're buying a small piece of ownership in a company. The dream is for high returns, which come from the price going up, and maybe from some dividends along the way. But, and this is a big but, the risk is high because prices can jump up and down like crazy. The upside is, for most listed shares, it's highly liquid, meaning you can sell it pretty easily. Just remember, dividends are a bonus share of profits. They are never guaranteed. All right, next up on the team is fixed income. And if equity is your T20 star, think of fixed income as your classic, dependable test batsman, you know, the wall. Not flashy, but incredibly solid and reliable. The goal here isn't to hit big sixes, but to steadily add runs to the board through predictable interest payments, which gives your whole portfolio stability. Now, here's the biggest difference from equity. With fixed income, you are not an owner, you are a lender. You're basically lending your money to a government or a company. In return, they promise to pay you a fixed, regular interest. So the returns are lower, but they're much more predictable. The risk is lower too, but, and this is critical to remember, it is not risk-free. Things like your bank FDs or government bonds fall right into this category. Okay, our third asset class isn't exactly a player. It's more like the entire home ground stadium itself. We're talking about real estate. This is a massive, physical, tangible asset. It's not something you can just trade with a click, but it provides a very solid foundation. And it can create value for you in 2 ways. First, if the property's price goes up, and second, by earning you a steady rental income. So, just like equity, you own this asset. But its performance hangs on one factor more than anything else: location, location, location. Now here's the catch, and it's a big one. Real estate is very illiquid. It can take months, sometimes even years, to sell a property and get your cash. And you can't forget about all the extra costs like maintenance and taxes that eat into your returns. And our final player, let's talk about commodities. And the star player here for most of us is gold. In our team, gold is like the wicketkeeper, a defensive player who really proves their worth when the team is under pressure. So during a market crash or an economic crisis, people rush to gold as a safe haven because it tends to hold its value when everything else is falling. Now, this is something you absolutely have to remember about commodities like gold. It is an ownership asset, yes, but it does not generate any income. Zero. No rent, no interest, no dividends. The only way you make money from gold is if you sell it for a higher price than you bought it for. The return is purely from capital appreciation. That's it. Okay, so we've met the whole team. We understand the theory, but how does this all translate from a textbook into your actual bank account? Let's talk about how this stuff works in the real world for investors here in India. Okay, probably the biggest mental shift you need to make is understanding this difference: owning versus lending. With ownership assets like your stocks, your property, your gold, you own a piece of it. The upside can be huge, but your final return is totally uncertain. On the other hand, with lending assets like your FDs or bonds, you're just a lender. You don't own anything. Your return is simply the interest rate that you agreed on up front. It's a fundamental difference. All right, another really practical idea is the difference between physical and financial assets. You can hold an asset in its physical form, something you can actually touch, like a flat you own or gold jewelry in a locker. Or you can own it in a financial form, which is basically a digital or paper contract. For example, instead of buying a whole office building, you could invest in a real estate mutual fund. Instead of buying physical gold biscuits, you can buy gold ETFs online. The financial form is just way more convenient and easier to buy and sell. Okay, let's put on our exam hats for a second. If you're studying for your NISM certification, this section is super important. How do they test these concepts, and what are the common traps you need to avoid? This is a key part of what we do here at ARGUNAS Learn, bridging theory and the exam. So let's talk about the common mistakes people make. We see these all the time. Number one, thinking the house you live in is an investment. It's not. It's for your own use. Number two, assuming fixed income means zero risk. It's lower risk for sure, but definitely not risk-free. Number three, expecting gold to give you some kind of regular income. Nope, it won't. And finally, number four, getting confused between owning an asset and just lending money. So, here's the big exam tip from us here at ARGUNAS Learn. The NSM exam loves to test your conceptual clarity. Don't just memorize definitions. For each of the four main asset classes, you need to be crystal clear on its core characteristics. Ask yourself, what's the risk level? How does it generate returns? How quickly can I sell it? And does it produce any income? If you can answer these four questions for each asset class, you'll be able to handle anything the exam throws at you. Whew, all right, that was a deep dive. Let's pull everything back together and boil it all down to a simple mental checklist you can walk away with. So to recap, first, remember that asset classes are just different categories of investments, like players on your cricket team. Second, you have to know the big four: equity, fixed income, real estate, and commodities. Third, always remember the difference between being an owner and being a lender. And finally, why does all this matter? Because the whole game is about building a balanced team, diversifying your money across these different asset classes to manage your risk and give yourself the best shot at reaching your financial goals. And that's a wrap on asset classes from us at ARGUNAS Learn. If this helped clear things up for you, do us a favor and hit that like button, subscribe to our channel, and ring that bell icon for more simple, clear explanations to help you on your journey. This video is for educational purposes only. It is not affiliated with, endorsed by, or sponsored by NISM, AMFI, or SEBI. Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing.